Welcome back to Ask a DHJJ CPA, the podcast where real CPAs answer real questions from business owners. I'm your host, Emma Yurchik. January is officially the kickoff of tax season, and for a lot of business owners, that can bring a mix of stress, urgency, and maybe a little regret about things that didn't get done last year. So today, instead of talking about filing returns, we're taking a step back to look at what we can learn from the 2025 tax season. What worked, what caused problems, and what business owners can still do now to make this tax season smoother and start planning for 2026. To help us do that, I'm joined by Mirella Hernandez. Mirella is a principal at DHJJ and the leader of our tax practice group. She works closely with mid-sized businesses across a range of industries, helping them to not just stay compliant, but plan strategically year after year. Mirella, thank you so much for being here. Before we dive in, can you tell our listeners a little bit more about your role and the types of clients you typically work with?
Sure, Emma. My role at the firm, like you said, is currently the tax practice group leader. I help set strategies and goals on financial performance, drive business development, and also ensure that our team is exceeding client expectations. I work very closely with our firm leadership team on the growth plan of the firm, technology implementation, and talent acquisition. The different types of clients that I work on really range from manufacturing, distribution, wholesale, technology, and other service providers as well.
Well, thank you so much for being here today. I'm super excited to talk all about tax planning, and we can just jump right in. So to set the stage, let's start by looking back. So when you think back on the 2025 tax season, what were the most common issues that created delays, stress, or problems for businesses?
It really depends on the client, depends on what's going on their business. I know from my client base, a lot of the delays are clients that were going through some sort of transaction. They were acquiring, they were merging, they were doing something from a structural standpoint. That tends to delay the process overall, not just for the tax side, but the financial side. And for the clients, I mean, it's fairly complicated to be buying out a business and having to integrate all that into their plan. So that causes delays. And obviously, gaps in communication, from both sides, from the CPA side and from the client side. When communication is not connected and it's not proactive, definitely can cause delays and stress.
Did you see any patterns kind of coming across in any industries or company sizes?
Um, I would say definitely companies that are smaller tend to have more challenges with having enough expertise in their firm and their company to tackle that. And that's when, great opportunity for their CPA to have a more active role in not just doing the tax work, but also helping them with purchase accounting, with helping them with reconciling and such. And larger companies, obviously, the transactions and challenges that they're going through, they tend to be obviously higher value, higher dollar. So there's more risk. Many times there's more people involved. So you're trying to meet everyone's expectations, trying to make sure that everyone is understanding what's going on. And yeah, when you have more people in the mix, that's a challenge in and of itself. So.
That makes sense. Were there any surprises that caught clients off guard from last year?
Surprises, yeah, I had a specific example of a client that acquired another business, and they were caught off guard regarding the acquirees, their tax period, their due dates, because it looked very different. So just having that proactive approach of understanding when you buy a company, when you're going through a transaction, it might not be the same due date. There might be a difference in tax year ends for the target versus the purchasing company. So that's something that if we're brought in early on to the transaction, we can kind of review the agreements, talk to their attorney that drafted the agreements and understand what the due dates are and what that tax return looks like as far as what year ends are included in what period, and just makes it really clear to understand that from day one.
Wow, that's definitely not something that I had considered, is that those dates would be different, especially if
Mhm.
you are acquiring a business. Definitely something to keep an eye out for.
Yep.
One thing I hear a lot from business owners is we thought we had everything in order until tax season hits. So, from your perspective, what are some early warning signs that a business is heading into tax season unprepared?
Well, I think the business warning sign that I think is if you haven't talked to your CPA in months, that's a problem. So typically, we like to meet with our clients throughout the year, talking about improvements in the relationship. What the CPA side can do better, what the client can do better, just really make the whole engagement process more seamless. So really, having that conversation throughout the year and just being that trusted advisor, I think overall helps to just set up everything for success.
That makes sense. We can't, go dark throughout the year and then jump into tax season and say, okay, we're ready to go.
Yeah.
That constant communication really is going to set you up for success. That makes a lot of sense. So we're sitting here in January and tax season is officially underway. For businesses listening right now, what should they be gathering or organizing right now?
So obviously year end is just happened, right? So most businesses are really busy right now closing the year end, reviewing their financials, looking to book their year end journal entries. And really that's kind of the beginning, I consider the start of the tax season is having the client really go through their closing process and doing that successfully. If that business is going through a financial statement audit or review and is engaged from an assurance standpoint, that's kind of the next step is for them to figure out what documents they need to send to their assurance team in order to get that underway. And then the tax team, can really piggy off of that. We do, work closely with our assurance team if the client is engaged on both sides, from the tax side and the assurance side, but also to just knowing how to knowing how to prioritize those lists for clients, because we understand as a business owner, your day-to-day is to run the business, right? So we're trying our very best to not make a list daunting, not give you so much more on your plate, and really help you prioritize and understand, these are the items that we really need, immediately, and other items can wait, especially if the expectation is that you are extending, then really typically not all documents on the list are necessary right before extension time. So just working with your CPA to prioritize those lists, I think are just help a business get a really great start to tax season.
It sounds like the communication to get those lists together is super important. And, we were talking a little bit earlier about communication with your CPA and
Mhm.
vice versa. So, what conversations should businesses be having internally and with their CPA to prep for tax season?
Yeah, conversations internally, I think, are really determining as a business what resources you have to complete certain tasks and understanding maybe where there's areas of risk or areas that you need additional assistance on from a CPA standpoint. So really having an understanding of that is helpful, and then communicating that to the CPA, as far as, we feel like this area on the financial side is really strong. This area, we do need further review. So we're having that conversation with your CPA is really helpful from the get-go. And then conversations, obviously, with your CPA is really everything to do with tax planning, understanding what the year looks like. Hopefully back in the end of 2025 projections were completed, you have an understanding of what that taxable income might look like for a business, and then understanding now that it's the year end, now it's the beginning of 2026, really knowing that what your tax plan looks like, what you should be expecting as far as tax due if you're in a positive taxable income position, and really if possibly if you are in a taxable loss standpoint, what refunds look like. So again, just really understanding what your tax plan looks like for the year, and really having an understanding from a cash flow standpoint of what that looks like as well.
Are there any deadlines or details that people tend to underestimate early in the year?
Yeah, actually from the new tax bill, and as far as I can remember, deadlines, except in the COVID years, deadlines shifted too many times that I can remember, right?
Oh, yes.
But deadlines, as of right now, continue to be, status quo as usual, as corporations, partnerships due March 15th. Corporations, individuals, and trusts continue to be due April 15th. So those really haven't changed at all, not even with the new tax bill. And obviously state returns, if you were a multi-state business, those really vary state by state, and obviously depending on the entity type and the form. So those sometimes can be a little confusing because sometimes they follow the federal due date and sometimes they don't. Texas, for example,
Okay.
Texas is probably one of those outliners that, really don't follow any due date from a federal standpoint. They have their own May 15th original due date, and then I think the extension is November 15th. So,
Okay.
so there always will be a handful of state returns that are completely not following federal due dates. So,
Got it. Got it. So if you had to give business owners a short January checklist, not everything, but the biggest priorities, what would be on it?
number one definitely would be get a good handle on your year-end financials. Um, Understand if there are typical reconciliations and journal entries that you have to do, go through that. If there was any non-typical transactions that occurred during the year, things that are not in the ordinary course of business, those tend to be more complicated and have more challenges as far as understanding from an accounting standpoint and a tax standpoint. So really, gathering any documents and agreements there are regarding those non-typical transactions, I think help, again, just to have enough time to review and have those discussions. And then two, have a plan, right? Have a plan with your CPA as far as what that timeline looks like, when those documents that have been requested, when are those expected, and also know that there has to be some flexibility, right, to every plan. We understand that as a business, again, as a business owner, your focus is to successfully run your business and attend to your clients and customers. So us on the CPA side, I think that we try to pivot and again have flexibility in those dates. But at the same time, too, we try to follow them as best we can so that we're on a good timeline, that we have enough time. We're not delivering things last minute because no one likes surprises. So
No, no one likes surprises. That's for
unless it's a
sure.
birthday surprise, unless it's a nice birthday gift.
Exactly. Good
But
surprises, yes. Tax
surprises,
surprises?
yeah,
No.
tax surprises, unless, again, I guess unless you're getting a huge refund, which um
I'll
usually
take
is
that
not the
surprise.
case. Usually it's a large, tax due bill. So trying to avoid surprises as best we can, I think definitely is a factor of that, is having really great planning with your CPA, and both parties, the business and the CPA, really understanding what that looks like.
Definitely. We talk about all the time at DHJJ, it's partnership
Yeah.
and, making sure that you're both working together for that best outcome. For someone who doesn't have an in-house accounting team and is wearing a lot of hats, what is the biggest bang for their buck that they can be doing right now?
So I think of a business like this, Emma, that like you just described, a business that's running really lean from an accounting standpoint. And a lot of our startup companies that we work with are in that space where they don't have a full accounting team. They likely don't have a designated CFO or a controller. And I think that the opportunity to work with their CPA firm on those other services outside of the tax world, I think are tremendously helpful. For example, DHJJ, we've got our client accounting services team that really can do the start to finish from a financial statement standpoint. They can help a client with monthly accounting, reconciliations, and if I feel like if the client is in a specific spot that they need a controller or a CFO, then outsourcing a controller or CFO is definitely a great option. So, and these
Definitely.
services really, I think allow the business to continue to run lean without having to invest internally in a full accounting team. They can really utilize their CPA firm for as their accounting team and so forth as their tax advisor, as their financial advisor as well. So
Yeah,
I think
absolutely.
yeah, I think the end goal for this is, businesses want to be able to produce an accurate financial, right? And they not all businesses have the ability to be able to do that internally. So I love the opportunity for us to be able to provide that for them.
Yeah, that makes sense. It is great to be able to get that outside help, bring someone in on an as-need basis versus having someone there full time, especially if, the business isn't ready for that. So
Mhm.
we at DHAJ, we love being able to help in all of those different areas. I love it. So let's talk about a situation I'm sure a lot of our listeners might even be in. So if a business owner realizes now in January that the 2025 records aren't perfect, is it too late to fix things?
I don't think it's never too late to fix things, especially if you are talking about a year that just closed. Obviously, when you are going back in history and back in time, there are tax years that close from a statute of limitation standpoint. Sometimes in those cases, there's not much that you can do, but if it's, we're in January and it's just the year end for 2025, there's always an opportunity to fix things. Again, kind of back to our last conversation regarding businesses having an accounting team or not. I think it's important to pinpoint what that risk area is, like what that fix looks like, what the problem might be, and then work with your CPA on figuring out who can take what role to get that issue resolved. From a tax standpoint, obviously, a lot of our clients, we do help from a accounting cleanup standpoint, but really our client accounting services team, that's their niche. That's what they do best. So really leaning on them to help do that, I think is definitely the key. So yeah, never too late, I think, to fix a financial or fix a problem. But again, just figuring out what the problem is and who's owning part of the resolution, I think is a big part of it.
Got it. So what types of issues can still be cleaned up or corrected, especially when we're looking back at 2025?
Yeah, so I think that, one of the big changes from the new tax bill is around 174 R&D expenses. So there are opportunities to a small business to go back and amend. So I don't want to get too deep into the 174 R&D. I'll do a shameless plug. We did spend quite a bit of time in the fall. We published some great articles and we had a webcast regarding R&D and 174 in the new tax bill. But definitely, I think that there is an opportunity to go back and amend certain years regarding that. So I think that obviously is a huge, huge opportunity for certain clients if they fall into that small business. And they had obviously 174 R&D expenses.
When might amended returns or additional documentation make sense?
I think amended returns make sense when there's a known error that is material in nature. If there is if there's also a missed opportunity, if there was a credit or an incentive or a deduction that was missed for whatever reason, going back to amend can definitely kind of get the taxpayer, the business back on track, be able to fix that error. And just as a reminder, the statute of limitations continues to be the same. It's 3 years. So 3 years from the date of a filing is typically the rule of thumb to go back and amend. So
Okay. So where do businesses tend to wait too long and potentially create risk?
there was something missed from a client book standpoint. Obviously, to us as CPA firms, we strive to have excellent service, but it is possible sometimes that we might have missed something from, a communication standpoint. We misunderstood something. So definitely amending for a known error that is material is recommended. Usually, I feel like businesses tend to wait long and kind of ignore when there's a problem or a challenge. Um, I think that it's very, human nature that when you foresee something not being uh, very clean cut, very, typical to your normal business accounting, sometimes it's easier, to ignore than to face it. So, um, I think that, encouraging our businesses again to really have that open dialogue throughout the year, that when they foresee a challenge coming or they foresee something that they're not comfortable with, having the conversation with us to determine what that looks like, what tax implications might be part of that, I think just will make the process a little bit easier. And hopefully the next time the business, will know what to do when they're encountering a challenge is not to wait to the last minute. And that definitely creates more risk, definitely closes the window of being able to plan. So again, just as a business, foreseeing those challenges, foreseeing those out of the ordinary transactions and talking to your CPA about it.
I think you hit the nail on the head. It is human nature to want to turn away from some of those big challenges. And, I
Yeah.
think sometimes there's even a fear of opening the door if things aren't
Hmm.
perfect and if things aren't looking great, right? So
Yeah.
what would you say to a business owner who's hesitant to dig into 2025 issues because they're worried about what they'll find?
I would definitely tell them, don't be hesitant, trust in your CPA. There might be an opportunity, some sort of tax savings if you do dig deeper into that issue. And obviously being more compliant. The structure of the IRS has changed quite drastically throughout the last couple of years. Their target areas of what the IRS is auditing has also changed too. So really increasing your chances of having a compliant tax return, I think is really important. And a lot of, again, those areas that are challenges, the correct tax answer is not always black and white, and it's not always, super easy to get to. But again, I think having that conversation and the CPA understanding what that looks like will allow them to really end up with a correct tax result that is, one, compliant with the IRS rules, and two is really, you're presenting a tax return that is giving the taxpayer an opportunity. And again, really closing the gap on any audit risk that may apply.
One thing we talk about a lot at DHJJ, and I feel like we really even touched on here today, is that tax planning isn't just a year-end activity. It's going on throughout the year. So even while businesses are in the middle of this tax season, what early moves should they be making now to improve next year's tax season?
I think it's never too late to think of future tax planning, right? Not just the current year, sometimes not even the following year, really looking ahead to understand what our clients' projections looks like, what they're projecting from a revenue, from an expense standpoint, and seeing how that fits into their tax goals and their tax strategy. Again, I think some opportunities from the new tax bill are giving us that chance to run projections to figure out really what's best for a client. Sometimes amending and being able to have tax savings immediate sounds great, but sometimes it's a better answer to really have those tax savings in the future. So again, being able to work with that business on future projections and understanding what their financial landscape looks like, and from a tax standpoint, how that looks like as well. So again, those conversations of multi-year planning, I think, help really the overall long-term tax strategy for a business.
Got it. What decisions benefit most from early planning rather than last minute actions?
Yeah, I honestly, I think tax planning really benefits everything, from a tax standpoint. I think that, we're able to analyze, multiple scenarios over multiple years, and just sometimes just give a business a little bit more time to debrief, right, with their CPA, and step back and determine, maybe I didn't think of this part of the financial plan. Um, just I think again, when things are not rushed and last minute, I think it just overall usually gives you a better answer. It's again some time to step back. Sometimes you got to get out of the details a little bit, look at it from a higher level and see, have we considered everything from a financial statement standpoint and from an income tax standpoint too, that will affect the overall tax plan for the business.
Okay. Are there common strategies that tend to get missed because planning starts too late?
Yeah, I would say definitely, timing of income and expenses. If that's being, you know, strategized in 2026 for the 2025 year, usually that's too late, right? You are definitely, at the end game for that. So if you are, if you are trying to be in a certain tax bracket, if you are working with your CPA firm on having a strategy to do those things, that needs to be planned for. It needs to usually happen before year end ends. Also, when you are trying to review certain federal and state credits and incentives, to determine eligibility for these things also takes time, right? So again, just being able to get ahead of the game from a planning standpoint really helps for a better strategy overall.
Got it. So how does this change for growing businesses or companies going through transitions?
I think it's typically more challenging, companies that are going through growth have a lot on their plate, right? They are, out there looking for new business. They're in a very business development mode. And sometimes they tend to focus sometimes on that more and focus a little bit less on the tax side. So I think being able to just have a really organized plan, have multiple touch points again throughout the year really helps to keep tax top of mind for those growing businesses. And again, those growing businesses, if they are going through if they're foreseeing a out of the ordinary transaction challenge, challenge that they may be encountering, getting us involved early on will just help for, I think, for an overall better plan.
Mhm. Definitely. So it sounds like the difference is really shifting from reaction mode to treating tax planning as an ongoing part of running the business. So from what you've seen, how does that shift actually impact the company over time?
Yeah, so I think a proactive versus a reactive mode is really setting the stage for better planning, short term, but most importantly, long term, right? So a tax strategy, I think, when you are with the right CPA, really becomes part of the overall business strategy for a business. So just really having that consultant advisor that is brought on, different times during the year. And again, it doesn't necessarily have to be when a client is going through a transaction or a challenge. I think just understanding what the business goals are for our clients is really important. That helps us strategize from a tax standpoint, what that tax strategy looks like, so that overall it's really one strategy, right? One business strategy for our clients, and tax is a really strong part of that.
Yeah. So before we wrap up, I would love to end with a few takeaways. If a business owner only remembers a few things from this episode, what are the top 3 to 5 actions you would want them to focus on right now?
So number one, I would say, is understand how the new tax bill affects your business and you as a business owner. There were, quite a few changes from a business and individual standpoint. And, a new tax bill can be complicated for most businesses to understand that, as most new tax laws are. So I think carving out time for businesses to understand how the new bill is affecting them on both the personal side and the business side, I think is really an immediate action that should be taken. Two is really setting measurable goals for your next year, right? So before a tax project starts, work with your CPA, set a timeline, set goals that can be measured. I think this helps you as a business and your CPA just stay on track. It helps you reassess if there's an obstacle or two along the way. And it really, again, helps you be flexible. And I think overall just makes the whole tax engagement just a little bit less stressful, is when you have known expectations on both sides. And then three is, if you're planning on a future transaction, please involve your CPA firm as soon as possible. M&A world is not easy to navigate, and you want to be well prepared in those times as you're going through due diligence, as you're going through negotiations, so that you are fully understanding the tax implications of that transaction.
Those are great. Thank you.
You're welcome.
Well, this has been incredibly helpful, and I think a good reminder that tax season doesn't have to be chaotic if you approach it the right way. Maria, thank you so much for sharing your insights and experience. And to our listeners, if you found this episode helpful, make sure to subscribe so you don't miss future episodes. If you have questions you'd like answered on future Ask a DHJJ CPA episode, drop them in the comments or reach out. We'd love to cover them. Thanks for listening, and we'll see you next time.